The Harmony funds are relatively cautiously positioned at the moment, particularly compared to the start of the year when the sharp falls in markets were presenting us with very good buying opportunities. Since then, we have generally been taking profits as markets have rebounded from those lows, including reducing equity allocations by approximately 3 to 4% over the course of the last quarter, moving the proceeds into short duration bonds and cash. Equity allocations across the Harmony funds are now at the low end of the range from the last couple of years, but nonetheless the funds still have half to two-thirds invested in equities, depending on the risk profile, reflecting our view that this is where the bulk of returns are going to come from over the medium term. Within that equity portion, we remain well diversified by sector, by geography, by style and by manager, while the remainder of the holdings within the funds are allocated across specific fixed income and alternative asset classes. Just within fixed income, we continue to avoid certain areas that look very expensive on valuation grounds, particularly UK, US and Eurozone government bonds, instead preferring higher yielding credit, emerging market bonds and convertible bonds. All of the Harmony funds delivered very strong returns in the third quarter of 2016, gaining between 3 to 6% net of fees in their base currencies. For the third quarter running, the sterling funds were among the best performers, with the balanced and growth profiles returning 5.1% and 6.3% respectively. The Asian funds were also among the top performers, gaining 4.5% for Asian balance and 6.1% for Asian growth, reflecting the strong outperformance of emerging market equities. Across the other funds, the US dollar balance and US dollar growth funds gained 3.6% and 4.6% respectively, while the European and Australian dollar growth funds gained approximately 3%. Year to date, the sterling funds have returned between 12 to 15% depending on the risk profile, while the Asian and US dollar funds are up by 6 to 8%, and the Australian dollar growth fund is up 4.5%. The laggard within the fund range has been the European Diversified Fund, up by just 1% this year, reflecting the weak performance of European equities, which are down 4% over the period. Well, so far, the UK Brexit referendum has not proven to be the globally systemic event that many had predicted. Most equity markets have recovered all or more of their immediate post-referendum falls. Global equities were up 4.8% over the quarter, and emerging markets up by almost 8%, both in local currency terms. As such, the equity portion of the Harmony funds contributed the bulk of the returns over the quarter. That said, our fixed income holdings also contributed substantial performance over the period, with high yield in the US, global convertible bonds, and hard currency emerging market bonds generally gaining between 3 and 4% and contributing to performance across all of the funds. In the sterling funds, our holdings in UK investment grade corporate bonds performed particularly well, gaining 5.6%. These compare to global government bond returns over the period of just minus 0.3% in local currency terms. Manager selection also made a substantial contribution to performance across all of the funds, most notably in the US portfolios, where it contributed over a quarter of returns over the period. In particular, two of our managers, Lyrical and Granahan, gained 8 and 18% respectively, and all but one of our managers outperformed the US market. Currency moves also impacted returns, with the US dollar and sterling weakening against other major currencies, which had the effect of boosting returns for the 20 to 30% invested in international markets in the sterling and dollar-based portfolios. The current cycle has further to run, but the recent strong rise in markets has taken valuations to levels that look vulnerable to a setback, with several near and medium-term risks that could potentially trigger this. We believe that the global economy will continue to grow modestly and will be supported by loose monetary policy for a long time to come, but some near-term caution is warranted. The Harmony funds have been well positioned for the recent strong rise in markets, which has led to excellent returns year to date. However, our return expectations from here are modest, and we are positioned more defensively than we were earlier in the year, with a view to taking advantage of any buying opportunities that any market volatility might present.